We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Don Durrett, author, investor, and founder of goldstockdata.com. Don, thanks for joining me today. How are you?
I'm doing good, Tom. I've been on your show more than anybody else's. I mean, we seem to do this every quarter, so we've done quite a few.
Well, I appreciate that, and it's always good to check in with you because you do have such an all-encompassing grasp of what matters from the macro side, what is happening from the macro side, as well as kind of going into the, let's say, the finite details within the world that we really care about. And that's, of course, the gold and silver mining stocks, juniors, explorers, stuff like that. So I wanted to start today by kind of asking you what, looking out over the next year specifically, what are some of the foreseeable issues that you think are going to be most important for the economy and for the markets?
Yeah, so where I would start with that is gold has been in a bull market since, I believe, December of 19. So we've been in a bull market for gold for a long time, but it really broke out in March of 24. That's when it really took off. And now we're kind of now it's obvious to everybody. I mean, we're at 3,300. We really haven't had any significant corrections. And from 2012 to 2019, that 7-year period, it was the end of 2019. So you could basically say 2020 is when gold kind of broke out. It was December of 19. So we had this 7-year correction in the miners and in gold. But we've kind of been fighting a wall of worry, though, from 2020 to now with the miners breaking out. But I think now we finally have gotten high enough on that wall of worry where now silver's above 35 and we're getting higher lows. I think we're starting to see where the bull market in the miners we're so close. We're on the precipice of it. We're not in that bull market yet. All we basically had is, we went all the way down to the HUI, which is the gold miner index. We went all the way down to 200 in October of 23, and then in February of 24. We went down to 200 again, and those are the final bottoms, if you will, of this 10-year plus bear market. And then now we bounced off that 200 and we went up to 400. So we went up 100%. But that 100% was more of a retrace. It wasn't a bull market off to the races. It was more of a retrace. So the bull market, if you look at that, I call it the chart from hell, the HUI. That's where we went down. We crashed down into this channel. And we just stayed in that channel for 10 years. I call it the channel from hell. And we broke out of that channel recently above 365. And today we're trading at 416, which is significantly out of the channel. So it feels like, we're broken out. The miners are off to the races. And I'm like, no, not yet. Hang on there. I do think we are in this bull market of higher lows. And so what we have, you have an opportunity to get in. You can get in now. You can get in the next correction, which I think it'll be somewhere between 10 and 20%, depending on what stock you hold. And then 10% higher from here, around 450, would be kind of the last chance zone. Mm-hmm. And then once we get above 450, I think it's going to be the train basically starts leaving the station at 450. At 500, it's gone. You look back, you don't even see the train station kind of thing. You missed it. Kind of all the stocks have pretty much doubled. So that's kind of an overview of kind of where we're at with gold and silver miners and where we're going. And I don't know, the next 6 months, I would say. Mm-hmm. Now let's get to the meat of the question, which is the macro side of things.
Well, maybe, Don, could I just get a couple clarifications before we go to the macro side of things?
Sure.
You mentioned that this gold's been really climbing this wall of worry. Gold and silver, the whole precious metals complex, let's say, has been climbing this wall of worry. What do you think contributes most to that wall of worry? Is it the, let's say the recency bias of the stock market performance? What do you think contributes to that most?
Well, it's been sentiment. So sentiment went in the toilet in 2012, 2013, and it's still there. So the real question is, why is it in the toilet and why hasn't it come out of the toilet? Why is sentiment still poor? Why is it so weak still? I mean, if you look at Newmont, it's trading at $58 today. It traded at $82 in 22. And the margins today are a lot higher than they were in 22. I mean, why was Newmont at 82 and 22 and now it's at 58? I mean, and it's not just Newmont. I mean, you look at Barrick. Barrick is the same. Their charts, Barrick's chart might be worse than Newmont. Now, Agnico has done better, absolutely, but it's done better because the margins are outstanding with Agnico, and people have kind of bought it. But the whole sector has not been bought, so that's sentiment. When sentiment improves, everything gets bought, and so sentiment is weak. And now you ask, why is it weak? And I've been trying to educate people on this because everybody seems to think that the miners. This actually kind of dovetails into a little bit of the macro. The miners perform well when the stock market performs poorly. And that's the only time. So you get these extended markets in the the miners. So we go back from 1972 to 1980. The miners did outstanding, and gold went up from $35 to $850. And that gold outperformed the markets. And not only did gold outperform the markets, but the markets didn't do well in the 70s, right? And then 1980, the economy came back to life when Reagan won. And from 1980 to 2000, 20 years, the miners did squat. And gold did squat. I mean, it was 20 years of pain. Now we've had 15 years of pain. Maybe not that many, 10, 2012 to 13 years. We're going on 13 years of pain. And so you get these cycles. But the up cycle for the miners is when gold outperforms the market, which it is doing in 25, but it didn't outperform the market last year in 24. The NASDAQ outperformed gold last year. So you still had the Mag 7, you still had people making money in stocks. And so now this year, but the market's almost at an all-time high right now. So that's that wall of worry. So Wall Street is like, I'm not going to go risk on and buy, risk off, excuse me. I'm not going to go risk off and buy these miners as a hedge when I can make money in in technology and, consumer discretionary, and, healthcare. And when you make money in these other areas, nobody's going to buy the miners. You only buy the miners when you have to. So that's the wall of worry. I call it wall of worry. It's kind of a misnomer. Basically, what I'm saying is that it's not going straight up in a line. It's like it's just slowly fighting, trying to break out. And so we need what I call a fear trade. So what is the fear trade? The fear trade is the average retail investor basically saying, I don't want to own stocks. He pulls out of the market, goes to the sideline, and he's not going back in. That's the fear trade. That's what happened in the 70s. That's what happened after 2000, 2001. People went to the sidelines. They didn't come back in until 2009. And so we need an extended bear market for the miners to do exceptionally well. So the breakout on the miners is going to coincide with the stock market rolling over. So I was going to go into macro unless you had a follow-up question.
No, I think that's a perfect, place we can go back to.
All right, so
that macro.
So we have not had a recession since 2009. I don't think you can count the short little blip in 2020 as a recession. It was a total blip and they were injecting money like crazy, but we did not, for me, the key to a recession is when you have companies laying off workers because they're not making money. Now, you could say that we had that in 2020, but it was an anomaly. It was basically, the COVID thing. So I don't consider that a recession. So I don't think we've had a recession since 2009. So we're coming on, 15 years plus. We're overdue. In tandem with that, if you look at, for instance, full-time jobs have been shrinking, and it's taking longer to replace them. So if you have a full-time job and you lose it, it's becoming more difficult to replace. That's not a sign of a vibrant economy. It's like a sign of a stagnant economy. And then housing has been, we're pretty much in another housing bubble right now, and inventories are going up. That's not a sign of a vibrant economy. I don't think you can make an argument that things are vibrant. Mm-hmm. I think that, and then if you look at the cost of living, they got hammered from 2021 to 2024, where you had this big loss in your spending power. That hasn't went away. So the average consumer is still dealing with that loss of spending power, which is impacting like retail sales, small businesses. You can make an argument that we're in a recession right now, but I say you're not, because we haven't had the mass layoffs. So the employment numbers basically imply we're not in a recession yet. And I think that's kind of the last shoe to drop. And so I think it's coming. I don't see a trigger for the economy to resume its vibrancies, to get stronger. So if an economy is slowing and there's no trigger to improve it. Now, people are saying, well, the trigger is going to be inflation under control and then the Fed dropping rates. They could be right. That might be the trigger. But it's going to be very, very close to how long does it take for those lower rates to take effect versus the slowing economy. It's flip a coin, who's going to win, right? The slowdown into a recession or the reinvigoration via more credit. But there's two factors here. The reason why I'm very bullish that gold's going higher. Now, again, the kryptonite for gold is strong economy. And so, but I say gold's going higher, so I don't see the kryptonite, right? Mm-hmm. So for me, the two big factors that I think are going to determine what happens over the next 6-12 months is, number one is going to be the tariffs and the impact they have. I think that July 9th, I think we're going to get shock number two. I could be wrong. It could be a nothing burger, but everybody's making fun of Trump, calling him the taco president. Trump always chickens out. And I don't think he's going to chicken out here. I think he's going to hold firm, because I think tariffs might be his number one tool, if you will, to change the American economy. In other words, he's using these tariffs to bring back manufacturing, to help and this is the second factor, which is debt. He's bringing back the manufacturing so that we generate wealth, so that our trade deficit isn't so serious, and we start to get more on our feet again. I don't think that Trump believes that globalism is healthy. And the globalism I'm talking about is where you have free trade across the board, and you make stuff in other countries, and it lowers the price of everything, and that's supposed to lift all the boats, right? That was the thesis that Reagan put in play. But what's happened is, when you lower the trade barriers, nothing gets made in America, right? We don't make any appliances here. We don't make any phones here. We don't make any computers here. There's a lot of stuff. We don't make pharmaceuticals. There's a lot of stuff we don't make here because of globalism. And Trump basically said, that's not working. And so tariffs is his strategy of changing that dynamic. So on July 9th, I really believe that he's not going to because that's when all these tariffs are supposed to fall off, right? Mm-hmm. Well, they're only going to fall off if Trump says, "Oh, that's it, you guys made a deal with me." Well, how many trade deals has there been? We got 2 weeks to go, and how many trade deals there's been? From my understanding, there's only been two, and one of them is not solid. The other is Great Britain made one, and the other one was China. But China's is temporary, right? It's not written, it's not finalized. So we really only have one trade deal, which is England. That to me, something's a little wishy-washy there. So he doesn't have a deal with Europe. He doesn't have a deal with Japan or South Korea or Pakistan or India. I don't know about Pakistan. I meant to say India. I don't think Pakistan exports much, but they do export some stuff. But these other countries, he could do a trade war with. He could basically say, the pause is done. Now here's your 50% tariffs. Now you have to negotiate, or I don't know, but okay, so the tariffs. So I think the tariffs are actually negative for the economy. And for instance, when Trump came into office, the average tariff coming into the U.S. was 2.5%. When they did the Big Better bill, they used 15%. That's what they think it's going to be. That was what their expectation is. So if we jump from 2.5 to 15, that's a big jump. And what happens if it goes higher than 15? What if it's 16, 17, 18? That's a tax. That's a significant tax. So I think the minimum is 15, and it's probably going to be a little higher than that. But here's the kicker on this. As we speak right now, the average tariff for an automobile coming from Asia or Europe is 25%. That's a big hit. For instance, my last car, I bought a Prius. I paid $30,000 for it. If I want to go to replace it today, it's 37 with the 25% tariff. It's $37,000. That's a big leap.
And that doesn't adjust for inflation either.
Right. So those tariffs are going to bite. And I don't think those 25% tariffs are going to come off the autos. And that's when Europe and Japan are going to start screaming. They're going to go, this isn't fair. You want to keep 20, you want us to pay 25 and then you only have to pay 10 or 5? No, we're not going to do that deal. That's not right. And so I think we're going to see some trade wars. Okay, so the tariffs is number one. The second one, which for me is the reason I invested, the reason why I own gold, is the budget deficit of the U.S. government. It's at $2 trillion, and the Big Better bill, the Big Beautiful bill, it really doesn't cut the deficit. Not in the near term, it doesn't. And so we're looking at, these massive budget deficits where they have to borrow. At $2 trillion, you have to borrow $166 billion every single month. But it gets worse. That is only for the budget deficit, the $2 trillion. Guess how much we have to roll over this year because we've been borrowing at the short end? We have to roll over 7. So we have to borrow $9 trillion this year. $9 trillion. That's a lot of money. Who's going to come up with $9 trillion?
Well, and isn't that window kind of compressed at this point because of the debt ceiling as well?
Yeah, it is compressed. They have to borrow more in the second half of the year this year. And so, yeah, we got to borrow a whole bunch of money. But my point is that they keep borrowing at the short end. So that $9 trillion, that next year it's going to roll over and they're going to have another big chunk of money they have to borrow. So you got the $2 trillion start off, and then you have to have all this rollover money. Now, people, the rollover money, that $7 trillion, what that is that's when you have to pay off the principal. So you have to basically come out. Now it's basically an accounting. It's really interesting. So accounting wise, our national debt doesn't go up because we call those assets. So we're basically holding that $7 trillion. We consider that an asset that we own. So when we pay it off and we go borrow it, and from the accounting standpoint, the national debt stays the same. So we don't necessarily have to pay more interest on it, but we have to pay off that principal. Right. So it's kind of, they call it a wash. So, and when people are watching the news, they see the national debt's only going up, but in actuality, the treasury auctions are massive in the back end because they're paying off they have to borrow money to pay off the principal of those other ones. So they basically replace those loans. They roll them over. But when you roll them over, you still have to pay off. You have to come up with the money to pay off the principal.
Don, how do you think about, let's say, the structure of the debt market right now? Of course, Yellen did a bunch of, let's say, financing at those shorter timelines. Combining that with China, let's say, dropping their treasury holdings to their lowest level since 2009 at 757 billion. What does the structure of all of that short-term debt, what is the consequence of all of that short-term debt end up being?
Well, the risk, and Basant talked about this before he came into office. Mm-hmm. He basically criticized Yellen and said that that's what she was doing. It added too much risk. Well, guess what? He's doing the same thing because he doesn't want to borrow at the long end at a higher rate, and he's hoping and praying that if he borrows at the short end, when he rolls them over, eventually he's going to be able to roll them over at lower rates. So they keep doing shorter and shorter terms so they don't want to lock in. So basically, you have 4% on short end, and then just a little over 4% on the longer end, 10-year plus. But if you do the longer end, you're locked in at that rate. And so you can, they prefer to borrow at lower rates. So they keep doing the shorter end, hoping and praying rates come down. But right now they're doing short end, and let's see how long they do it. But this $9 trillion, I'll bet you most of it is short term. Mm-hmm. And so they have to keep rolling it over. And then because rates are never going back to zero, or they're never going back to one, I don't believe. So it's a perpetual problem, I think. I think the reason why I'm mentioning this, the reason why I invest in gold is because I believe the U.S., and people talk about this, people have done research on it, is that once your national debt gets above a certain level, like 120%, you never come back from that. Mm-hmm. You eventually default. Once you get to a certain point, it's like a kind of a point of no return kind of thing. And I think that's where the U.S. is today, that we've crossed that threshold, and there's no way back, because now that our debt load is so high, you can't cut the deficit. In other words, our deficit is 1 trillion just interest. Just interest alone is 1 trillion. Mm-hmm. And our budget is 1 trillion average year. So, and that's all basically, part of this deficit. So you can't cut that. Mm-hmm. So how do you, balance a budget when you have $1 trillion in interest? It's impossible. And so at a certain point, if you look at what Doge attempted to do, there's actually a website that shows you how much money that Doge has saved this year. It's like 180 billion, but it's really peanuts. When you look at the overall budget and the annual deficit, you really need to cut $1 trillion. And even if you cut $1 trillion, remember they cut 180 billion. Even if you cut 1 trillion, you still have a $1 trillion deficit. Mm-hmm. I mean, it's not as if $1 trillion deficit isn't significant. It is significant, because remember I said earlier, that 1 trillion is only the starting point, because you have all this 37 trillion you keep rolling over, because you don't have enough income to pay off that principal. The way you pay off principal is with, savings. Mm-hmm. But we don't have any savings, so we can't.
Higher income than your debt payments.
Yeah, we don't have that. So that's where that 37 trillion just keeps, getting worse. The problem just gets worse and worse and worse, and you get into this debt loop. And then eventually what's going to happen is people will recognize that we're in a debt loop, and they don't want to hold our debt. They're like, I don't want anything to do with your debt. We're already starting to see it on the long end, where nobody wants to buy the long end. And that's why we're not seeing very many auctions at the long end. I heard somebody say that the Fed hasn't sold any 10-year, 20-year, or 30-year that's on their balance sheet. I forget exactly what it was. They're still holding them all. I don't know if they sell them. Something about the Fed is showing, they're basically showing that there's no demand out there for for these long end bonds, and it's already starting. Everybody wants to short in. And they don't want to short in necessarily for inflation or risk. I mean, it is risk, but inflation but it's more of a risk thing. They're basically saying, we don't think those 10-year bonds are smart investments. We're probably going to lose money on them because your inflation is going to go higher because your debt problem. And this comes back to the fiscal dominance problem, where if the government does cut, if they decide that they want to have fiscal austerity, they want to balance the budget, if they start cutting spending, that will hurt the economy. So Washington doesn't want to cut spending. Yeah, they cut Doge, but that wasn't really spending. That was kind of, they were basically laying people off. That wasn't cutting spending per se. It was basically more salaries, more labor. Mm-hmm. I think, and they did cut some spending. I will give them that. I mean, there were some programs, right? There were some programs that they cut, but a big chunk of it was labor. But on the whole, you don't see Washington in any mood for fiscal austerity, and I don't think it's going to happen. I think Lynn Alden talks about it. No one stops this train as far as government spending goes. They're just going to. That's what they do. They spend money, and they're going to keep spending. And I think that has an end game. Now, some people think the end game, we can keep kicking the can,
MMT.
Keep kicking the can. It's not going to happen, anytime soon. But my belief, and I could be completely wrong here, but I'm uber bullish on this, is that when this recession hits, that I think is inevitable, that is really going to be the undoing of this debt bubble. In other words, I think what's going to happen is when you go into recession, all the leverage in the system is going to start blowing up, and the Fed and the Treasury are not going to do what they've been able to do in the past, which is basically implement bailouts to reset the economy like they did in 2009. But I don't think they're going to be able to do it this time because they can only print so much money without creating inflation, without hurting the bond market. And so in 2009, we didn't have any inflation, and we didn't have this huge debt problem we have today. We didn't have the huge budget deficit problem we have today. Mm-hmm. So they are kind of behind the eight ball. And so when we do go into recession, I think that the leverage in the system is going to somewhat spin out of control, where the emperor is going to be shown that the emperor doesn't have any clothes, where the emperor cannot be proactive. I think what's going to happen is the Fed and the Treasury are actually going to start being reactive, where they basically can only lower rates so far. They can only print so much money, but it won't work. And they'll ratchet it up a little more, but it won't work. And then once we see that it's not working, what's going to happen is that's when the recession starts. And basically what they're doing isn't helping the economy. It's not working. That's when things really start spinning out of control. So I think the big, we don't know exactly where the weaknesses are in the economy, but I think where it's going to be is the regional banks. I think the regional banks are going to start closing left and right, and the FDIC is not going to have enough money to bail them out. And they're going to do bail-ins, and that's going to be kind of that's when things are going to get bad. That's when things start spinning out of control, because it's going to be a little bit like the savings and loans where you had hundreds of banks close. I think it's going to be like that. But this isn't going to be savings and loans. It's going to be regional banks. And so it's going to be worse than that. And I just think, David Hunter talks about, he calls it the bust, right? The global, the U.S., this bust that's coming, this massive thing. And I kind of see it the same way, where things really start breaking down. But simultaneous to that, I don't see the economy going into a depression. What I see happening is I see winners and losers. In other words, even when you have a recession, if some of us have been around and experienced these recessions, So I was 20 years old in 1980, so I remember that. I remember 1980. 1980 was kind of a severe recession, right? But the economy was working. It was you couldn't really tell that you're in a recession. I mean, if you drove around town, people were working, right? People had a job. If you didn't have a job, there was a problem. But we had high interest rates, really, really high interest rates. And we were in a serious recession. That's kind of how it's going to be. The problem is if you lost your job in 1978, 1980, it was hard to replace it. But if you had a job, you were okay. So it was basically winners and losers. That's what I see coming here. Is that you don't want to lose your job. You lose your job, and it's a pain in the butt to get it back. Nobody's hiring. If that's what we're going to see. We're going to see a kind of a nobody's hiring. But Walmart will still be open. UPS will still be running. But the economy will just be, it'll be like the late 70s where they called it malaise. It's not a good time to start a business. All you're doing is hanging on. But if you have a job, you got a paycheck, you're doing okay. But you know that that other people are hurting kind of thing, but it's basically winners and losers. And that's what I see coming. I don't see a depression, just kind of a severe recession that lingers. I think this recession is going to linger for a long time, maybe the rest of the decade.
Mm-hmm. So Don, as you mentioned, this idea of basically inability to keep financing these deficit issues, how do you look at the Fed basically coming in to be the lender of last resort here? Trump announced that he, supposedly has picked the successor for Jerome Powell for the Fed chair. And one would think that that's somebody that is going to work with him far more complementary than Powell is willing to at this point. Without the political chemistry aside, let's call it. But
right.
Don't you think that the Fed is going to come in at some point, go back to QE with water bombers instead of helicopters, and that is also a signal and a catalyst for the gold miners?
I'm going to leave the gold miners out of this. I'm going to talk about the Fed. So the Fed is the last resort. So this is where it starts to break down. Remember, I said that they're going to be reactive, and everything that they try is not going to work. So they're going to be, bail out here, bail out there, and inject money here, QE here, lower rates here. In other words, incremental stuff. They're going to start trying stuff, right? But what's going to happen is we're going to turn Japanese. But the one thing that they're not going to do is they're not going to lower rates to zero. They're not going to lower rates to 1%, and they're not going to inject money and hand it out hand over fist, because they know that would create inflation. So they're going to turn Japanese. And basically what happened in Japanese in the early 1990s is they basically could not restart the economy. They call it the lost decade. So everything that the Japanese central bank tried and the government tried failed. They kept trying. They tried this, they tried that. Nothing worked. Nothing worked. It was like they called it pushing on a string.
Right.
You can lower rates to zero. They actually had negative rates. Mm-hmm. Didn't work. They injected money. Didn't work. Nothing worked. That's what's going to happen to us. That was their bubble. So this is our debt bubble popping. That was their debt bubble popping. It's the same. It's basically the same thing. So when the debt bubble pops, it's like pushing on a string. It's like nothing you do works. And that's what's going to happen here. It's going to be like pushing on a string. Lower rates, nothing does not working. Mm-hmm. And the reason why, and no one's going to be hiring. It's like, so the layoffs start, right? And nobody's hiring. And then how do you get people to hire? How do you restart it, right? How do you restart this thing? And they're not going to be able to. That's what I say. That once this thing turns south, once this recession begins, and once it goes. The one thing, for instance, I watch, CNBC's business shows, in the morning when I stretch, and then when I have lunch, I'll watch closing bell just to get the heartbeat of Wall Street. I wanted to get the heartbeat of Wall Street. Well, Wall Street right now is all happy because they're looking at the GDP numbers, they're looking at the employment numbers, they're looking at income, and they're thinking everything's fine. Everything's fine. And they can, but they're not looking out. They're not looking at this holistically of the weaknesses, the leverage in the system, the debt in the system, and like the housing market, the tariffs. If you look at it holistically and you look at all the data points, you should be scared to death. We're hanging on by a thread here. Steph Pomboy says that the economy is basically on air right now. There's no strength, there's no substance there. There's nothing really holding this stuff up other than money, money printing. And it's true. If we didn't have a $2 trillion deficit, because that $2 trillion is counted in GDP, we are living on debt. If you take that $2 trillion and you subtract it out from GDP calculations, we are in a recession. And people will be laying people off left and right. But the injections of the money, that fiscal dominance is keeping us alive. So when things do turn, everybody's confident that, the reason why you don't hear people like me on CNBC is because the mainstream narrative, the mainstream belief system is that the US economy is the strongest economy in the world. It's vibrant, it's strong, it's going to be here for, another 50 years. There's no problems with it. That's the narrative, right? When in actuality, it's hanging on by a thread by using debt expansion. Well, the reason why when it turns south that we're going to be pushing on a string like Japan did is because of what von Mises said. Von Mises, he wrote a paper in the 50s, and he said that you cannot create economic growth using debt without either paying that debt back or having a crisis. He basically said there's no free lunch. And we're about to find out that that's the truth. That you can't just print prosperity. You can't just live off debt. And eventually it bites you, it pops. And when it pops, that's when you're pushing on that string and nothing's working. And like I said, I'm uber bullish that that's going to be the outcome. And that's why I'm very excited about owning these gold miners, because that's who benefits. When the S&P finally stops going up, and I think it's going to drop 30% between now and the first of the year. When it stops going up, the stock market stops going up, that's when gold and the gold miners are going to be the winners, because they're the only game in town. And a lot of people like commodities, if you will. I don't, and because I believe we're heading into a global recession. So we're going into a global recession. You're not going to have a lot of demand for copper. Like, people love copper, and I'm like, well, that's not what I see. Now I see copper prices going up because I see inflation going up. I see oil going up. Maybe some of the oil stocks will do good because I think oil is going north of 120. So I see that because that's inflation, because the Fed's going to print a lot of money. But zinc, and nickel, I'm not super bullish. If you have one of those mines, if you're already in production, yes, but if you want to build one, I don't see the demand really taking off here in the next 5 years. I see once this recession starts, I think it's going to be a nasty global recession that lasts about 5 years. And that's that global bust that, that Hunter's talking about, look out below kind of thing when this recession starts.
So, Don, obviously, we kind of started the show, or I started the show very deliberately by asking you these foreseeable, headwinds that we can expect to have effect within this year. But what about something like, Iran, for example, closing the Strait of Hormuz right now? What effect would that have on, obviously, oil prices and in turn inflation for the rest of the year? And, what are the ramifications of that?
Well, if they were going to close the strait, they would have done it already, I believe. The one thing about closing the strait is it would hurt their allies, especially China,
Mhm.
and they could also lose market share. So China would go somewhere else to buy their oil. So I know market share is really important to these guys. So if they were going to close the strait, I think would have already done it. So I don't think that's going to happen. So, but I do think oil prices are going higher. The one thing about this whole Iran-Israel confrontation, as far as gold and silver, I don't think that is needed, if you will, in problems in the Middle East or oil prices. I don't think any of that is necessary for gold prices to go higher. I think what's necessary for oil prices to go higher is the U.S. economy going into recession. That's the key to it all. And I think there's nothing going to stop that from happening. Higher oil prices just speed it up. But I think tariffs alone is probably going to be enough to push us into recession. High oil prices are just like extra. They just maybe, speed it up a little bit, make it worse. But, in other words, we don't need Middle East issues per se. Even the global South, which I think is a de-dollarization. I think that is in process. I think that is occurring. I think de-dollarization, where the global South is steadily dropping our reserves and trying to move towards a system that is not so dependent on the dollar. I think that is happening, and that will continue to happen, and it will continue to progress because I think the global South recognizes that the dollar is inflationary. It's actually hurting them too much now, that the US's debt is causing inflation and weakening the dollar. I mean, if you look at it, I love it when people talk about how much the dollar has dropped like over the last 5 years. It's pretty significant. I mean, there's like 20% drop in the dollar in 5 years.
Mm-hmm.
That's significant if you're holding bonds. You're getting, your principal just got whacked. Because you're going to get it when you get your principal back, you get it back in dollars, and it's dropped 20%, right? So people are starting to recognize that holding these treasuries is not a good thing when you have inflation. So people are trying to move away from the dollar as much as they can. Also, as far as reserves, the dollar reserves, you mentioned that China has 750 billion in our treasuries. They had at one time they were almost 1.5, and now they're 1.7. I believe I've said this for many years now, that once China gets below a certain threshold, Japan's going to start selling because of game theory. So Japan has 1 trillion, right? And so at a certain point, when China gets below 500 billion, excuse me, Japan's going to go, are we going to be left holding the bag? What if the U.S. defaults? If they default, we're going to lose our butt. And China, who's their competitor, is basically laughing at you. Hey guys, how's that bag? How heavy is that bag, right? So China, once they get below 500 billion, I really believe Japan's going to basically go, okay, it's our turn. We got to start dumping too. And so you got to watch that closely. It won't take long. I mean, they could dump 100 billion in 1 quarter. They can go from 750 to 650, and it would be kind of game on. And I think that's what's going to happen. So when the recession begins, and they recognize, and China looks around, they say, the U.S. is screwed. The U.S., they basically have analyzed it the way I've analyzed it, and they realize the U.S. is screwed here. They basically are going to experience this Japanese type of scenario where they're pushed on a string and they can't restart their economy. And once that happens, the dollar's going to get weakened, inflation's going to go up, printing's going to go up. Larry Lepard's the big print. They don't have any choice. They're just going to print. Everybody sees that. That's their only option, right? Well, at that point, China goes dump. Get rid of those bonds, right? And they get below 500 billion, and then Japan goes, and they start dumping. At that point, interest rates are going to go up, right? If they're both dumping, interest rates are going up, and it's kind of a negative feedback loop, right? At that point, who's buying the bonds? The Fed, right? They're the buyer of last resort. Well, guess what happens when the Fed buys bonds? That's newly printed money. That creates inflation. There's your negative feedback loop. So, I mean, when you really kind of flesh out what's coming, and this is kind of the von Mises bubble situation. I haven't really talked about Triffin's dilemma, but I want to add that. I want to talk a little bit about Triffin's dilemma because I think Triffin's dilemma might be the most important factor in all of this. And Triffin's dilemma basically says you can't, von Mises basically says that if you create a debt bubble, you got to pay it back or it pops, right? Triffin's dilemma says you don't want the reserve currency. That's bad. If you own the reserve currency, your economy is screwed. And you're screwing yourself. I mean, that's pretty much what Triffin's dilemma says. You are screwing yourself because your currency, because everybody in the world's using it, is going to be stronger than everybody else's currency. And since it's stronger than everybody else's currency, you're at a disadvantage economically versus your competitors. Because they have an advantage because their currency is weaker, so their labor costs are lower, so they can make stuff lower. That's what Triffin said in the 60s. And that's true. That is so, he was so spot on. We don't make anything today. That is what Triffin said. But what Triffin also said was, once you stop making stuff, you're screwed. You're bankrupt. And that's what's happened. And so Triffin's dilemma is actually the most cogent argument for holding gold, because he basically, and when you combine von Mises and Triffin, it's like, okay, I can connect the dots here. The U.S. is screwed. We're screwed. And Trump is basically doing a desperation play with his tariffs, saying, "Oh no, we're going to fix this Triffin thing. We're going to bring back manufacturing." Well, Triffin's basically saying, "You can't. Your dollar's too strong." And notice how Trump has said we got to weaken the dollar. We got to weaken the dollar, right? That's Triffin. He's going, but you can't weaken it enough, right? And then Trump said we don't care about making socks. Trump said we don't care about making socks, right? Because he knows he can't compete on making socks, right? Mm-hmm. We're just going to make high value items. That's not going to do the trick, right? It's just a little desperation trying to keep it alive, trying to keep the debt market, the U.S. Treasury bond market, keep that strong. Tariffs is all about keeping that debt market strong because guess what? We depend on it. We depend on borrowing money, and we can't print it. We got to borrow it. We need to borrow it from people that have money. We can't monetize it. The Treasury, the Fed can't just monetize it and just print it and print it and print it. That destroys your currency. We need investors. We need foreigners. We need people to buy our debt, right? But the problem is you don't want to do that when the economy is growing. You don't want to have budget deficits when the economy is growing. That's where we screwed up. It's okay to borrow money during like World War II in the 40s. It's okay to borrow money then. During a war, you can borrow when you need it. But once your economy is growing, borrowing more is foolish. And so that's the von Mises bubble. And then Triffin's dilemma is over here saying, you're screwed, you don't even know it. Mm-hmm. So we've been in denial. We've been in denial of Triffin's dilemma, and we've been in denial of von Mises. And Washington, right, who has all the narratives, and Wall Street, which has all the narratives, they're just spinning it in their favor. Wall Street, they're just spinning all the good news, keeping everybody happy, buy our products, buy stocks and bonds, right? And Peter Schiff gets on maybe once a quarter, right? And then Washington, they pretend that debt doesn't matter, the MMT crowd. The Democrats pretend that the economy is all automatic. It's all automatic. It runs on autopilot. Mm-hmm. If you listen to them, right? It's all autopilot. We can raise taxes to the moon. The economy never dies. The economy doesn't work. So in actuality, America has really screwed itself big time, and we're about to hit that wall. and nobody can see it coming because everybody's paying attention to Wall Street and Washington.
Mm-hmm.
They always say don't listen to the mainstream news because they're everything they're lying. Don't listen to Washington. Well, guess what? Don't listen to Wall Street either. All three of them are basically spinning the news. Mainstream media, Washington, and Wall Street. All three of those are spinning the news. Have you ever heard anybody that works on Wall Street mention von Mises or Triffin? No, you haven't. Those are forbidden.
Maybe just to say that they were wrong.
Maybe, but you can't say those terms. They're forbidden. It's you'll get fired. I mean, there's a few guys. It cracks me up. These bulls that come on like the closing bell. Mm-hmm. It cracks me up how they spin everything positive. It's mind-boggling to me. And when all this stuff, and remember when 2008 happened, Wall Street said nobody could have saw this coming. Do you remember that?
Yeah.
I mean, what do you mean you couldn't see it coming? It's clear as day. And this is more clear as day. The perfect example. So I pay attention. So I'm not paying attention to Wall Street, mainstream media, or Washington, right? So I'm paying attention to the guys that have been doing this for a long time. Jeremy Grantham, Jim Rogers. If we just use those two, Stanley Druckenmiller. Jeremy Grantham says this is the most. What did he say? The most fragile economy he's ever seen. Most fragile ever. And he's seen some fragile ones. He saw Japan, and he predicted the Japan crash. He saw, the 1980s. He saw the 2007. He saw those three that were all massive, and he predicted all three. He said this one is the most fragile, right? Jim Rogers said, what's happening today has never happened before. And he goes, Jim Rogers has been around a while, right? He said, what's happening? He goes, we've never seen an extended bull market like this ever in my lifetime. And he goes, if there's anything that I've learned from history, I like the way he talks. He goes, if there's anything I've learned from history, because you can't avoid it. In other words, you can't avoid another recession. It's coming. And then the other thing he said, he goes, I would be I forget if he used nervous or concerned. It was one of those, I would be even use nervous or concerned right today, right? So you have people that have been in this business for a long time that, they're not on Wall Street or Washington, right? And they're telling you that the U.S. is in big, big trouble here. And so that's why I said, and I'm not talking my book on gold. That's what I'm investing in. But I'm just telling you that I think he said, be very careful. That's what he said. He said, I would be very careful. Mm-hmm. And he's talking about having money invested in the stock market right now. I'd be very careful because this is extraordinarily unusual, this bull market. I mean, if you look at the S&P chart from 2009 today, it's basically straight up. And so we are overdue. And like I said, when this thing does break, and I think it's going to be soon, I don't think they're going to be able to fix it. I think this is a Humpty Dumpty moment. Humpty Dumpty is going to fall off the wall here, and they're not going to be able to put the pieces back together.
Don, getting back to, let's say our world of gold and silver here, obviously silver has had an excellent run over the last couple weeks or month here. We've seen just barely touch $37, kind of get closed back down here. Do you think that this is a bull trap for silver at this point?
You must not read my Friday recaps. Yeah, I'm calling this a bull trap. Absolutely. And the reason why I'm calling it a bull trap is because I don't believe that gold and silver can run faster than the S&P. And I don't think the S&P can run very much more from this. So I think that, silver's catching up a little bit to gold, but the GSR still, I think it's like 92, mm-hmm. Somewhere around there. So it's still very elevated. So silver is still really, really low. So for silver to be at 35, 36, I mean, that's where it should be. But this isn't a breakout yet in silver, because that GSR is huge. But And I don't think gold and silver are going to, kind of take off on their own, if you will. So I don't see silver like ripping to 45 before the next correction comes. So people that are buying the silver miners, so you wanted to buy the silver miners when the HUI was at 200. And you want to buy low, not buy high, but people don't like to buy low. They prefer to buy high. That's just, I don't know why. That's just how people are. And they wait until you get a breakout, and then they want to jump in. And so a lot of people are buying now. Now it's okay because we are in a bull market for the miners. I don't think we're going to get any big dips, but they will have to hold on because this is a bull trap. I think that silver is going to go back down somewhere between $30 and 33. Hopefully 33 holds, but it'll go from, like right now it's almost 36, 35.85. It'll go down into a 33 handle in a heartbeat, and that probably won't hold. And then we're probably going to go 32, 31 handle and maybe a 30 handle. So I do think there's a good chance that 30 holds. So there's your bull trap, if you will. But it won't last long because we're getting higher lows. So when that correction comes, and I think it'll come fairly quickly, but maybe we have to wait all the way till October, November before that big correction comes. It'll be short-lived. And then silver and gold will, they'll correct with the market, and then they'll take off. Then we'll get that breakout. But the one thing that was obvious to me is silver's not ready to run here. So when we got to 35, 36, the way that I looked at it, it's like it's not ready to run.
Why?
And the reason why it's not ready to run is because Wall Street doesn't really care about. Wall Street still thinks that everything's fine. Silver runs when you have a fear trade. I mean, perfect example is 2020. In 2020, you basically had in the summer, you had silver go from 18 to 29 in a little over 2 months. 2.5 months. It went from, if you do the math on it, that was quite a run. And the reason why it was running is because of the uncertainty of COVID. And that was really the last time you really had a kind of a 2.5 month run where it was just ripping for 2.5 months. This one, going from 33 to 35, that's not a run. We really haven't had a run in silver since 2020. And so I'm saying you don't have that fear. And then the last time we had a run was, 2010 to 2011. And that was you still had the belief that we didn't know what was going to happen as far as the Fed fixing things. The fear trade was still alive. And that was kind of the final melt up of gold and silver, the final and then, I don't know, people thought that maybe we'd get a recession. But like I said, it's not ready to run yet. And when it's ready to run, you'll know it's ready to run. And I really believe it's going to be a fear trade. When people are buying silver at their local coin shop, people that are buying that don't own silver, that's your fear trade. That's when silver's running. Is when people they're watching the news and they're going, I want some silver. And they go down to their coin shop for the first time ever, right? And they pluck down $1,000, get $1,000 worth of silver. That's a fear trade. That we don't have that today. As a matter of fact, more people are selling than buying. And prior to 35, it was like 7-to-1 were selling to buying. Now we're above 35, and it's still probably 2-to-1 sellers to buyers. And so, you need 5-to-1 buyers to sellers. As a matter of fact, once it turns and once the buyers show up at these coin shops, they will be sold out within a month. You won't be able to find any physical silver in your local community. It'll be gone. And all you'll be able to do is walk in and order it. You'll be able to order it, but you won't have any.
Go on a wait list.
You get on a wait list, and as soon as it comes in, it goes out the door, kind of thing. And yeah, it's called unobtainable. You won't be able to find any locally. And the same thing I think will happen online. I think that, once APMEX is out of inventory, APMEX has the largest inventory, American Precious Metals Exchange. Once they're out, guarantee you the rest of the internet will be out within a month. If people go to APMEX and they can't find any 5-ounce, 10-ounce, or 100-ounce bars, if they can't find those, then they're going to start hunting for it on other websites. And word will get around. There's no inventory. APMEX is out. And at that point, people will start hoarding it, and they'll basically try to find it. And you won't be able to find any online. You'll be able to order it, but you won't be able to 30-day, 60-day wait. Mm-hmm. But you won't be able. They won't have any. It'll be out of inventory. That's going to happen too, because the inventories are just so low. They're very low, and people can buy at a coin shop fairly quickly. It doesn't. They don't have. They might have $10,000 in inventory, maybe. Most of your coin shops, right? And they go through it in a weekend, and then it takes them a while to get some in stock. So it's just that's what's coming. The unobtainable is coming, where you can't find silver.
Do you think that ends up applying to gold around that same time as well?
No, you can always find gold. There's plenty of inventory, and gold's $3,000 an ounce, so people can't afford it. I don't see any problem with gold inventories, but silver's a proxy to gold, so most of your retail crowd is going to be buying. It's going to be buying silver because they have $500 to $1,000, but they don't have 3,000, right, or 5,000, right? And so most of your retail crowd is going to be buying silver. And I don't see any inventory issues with gold, but definitely with silver, I see that definitely happening. The one thing, silver is going to be shocking to people, because once silver gets above $50, it's going to be an eye opener. Because it's going to be the first time it's ever happened. We've never been above 50. So when we get above 50, one thing, silver is an unusual asset in that people don't want silver at $20, but they want it at 50. It's a strange asset. People want it. Once it gets above,
Giffen good.
It's a Giffen good. Thank you. That's what the higher it goes, the more it's wanted. I want some silver. Look at that, $50. Wow, I want some of that silver, right? The demand goes up. Demand increases as the price goes up. It's a very odd asset. And so once you get above 50, the demand is going to be voracious. It's going to be some serious demand for it. And guess by who? The billionaires. The billionaires who don't own any silver today, and there's a lot of them, or the multimillionaires who don't own any silver. And it gets about 50 and they go, oh, that's a pretty nice asset. I want some of that stuff, right? And so the demand really starts to explode above $50, I think. And then you can't find it. That's the one thing, is the combination of the Giffen good and rarity, where you can't find it. It makes it, oh wow, look at that stuff. Can't find any silver. I want some of that stuff, right? It becomes a nice collectible, and so I think that's what we're going to end up seeing. And again, it all coincides with the fear trade. That's the key to it all, where people are watching the news and they're seeing all this bad news. Right. And then they go over to the business channel and it flashes silver, $47, Wow, look at that. I think I want some of that stuff. That silver just keeps going up, up, up. I need some. And there's no counterparty risk. Just go get yourself a few 10-ounce bars, and it's wealth in your pocket kind of thing.
I guess the only risk to that is trying to either get out in time, as we've seen historically that it's a quick spike to, let's say, above $50, or just trying to find a buyer in general at higher prices?
Well, that's the beauty of this coming bull market, is neither of those are going to be in play, because number one, silver's not going to go down this time. This is kind of a new era for precious metals. Gold, the reason why silver's going to be up above 50 is because gold's going to go higher. And gold's going to be going higher for a reason, because of debt and people moving away and people wanting security. So gold is the driver. Silver is just following. I call gold big brother and silver little sis. And silver is the feminine. You can't understand silver. It's uncontrollable, right? And so little sis is going to follow her big brother. Mm-hmm. That's just how it works. And so once we get above 50, people are going to realize silver's here to stay. And not only is it going to be a really strong asset to hold, but it will be easy to sell. You said, worried about it. It'll be highly liquid. Matter of fact, your coin shop, it'll be unobtainable. You go into your coin shop and he's going to be with a smile on his face. How much you got? How many ounces can you give me? I can move these. I can move these today. Mm-hmm. I think that the demand will be voracious. I actually think that the demand will be so high that we will have shortages. Because once once retail is cleaned out, at that point, in order to refill the inventory on the retail level, what you have to do is you have to buy the 1,000-ounce bars, and the 1,000-ounce bars is the key. So they have to buy the 1,000-ounce bars and turn them into 5-ounce, 10-ounce, and 100-ounce bars. Mm-hmm. And when they do that, when they buy those 1,000-ounce bars, they are taking away the inventory from the fabricators. And that inventory is already low. As we've seen, the last 4 years, we've had deficits of over 100 million ounces. So that's all 1,000-ounce bar inventory that's shrinking. And so the retail is going to need a lot of 1,000-ounce bars to replenish. Mm-hmm. And they're going to be sucking it up. And I think what's going to happen is you're going to get a shortage in 1,000-ounce bars. And that's what's going to push silver to $100, is shortages. And we're going to see it. And I think we're definitely going to see shortages.
Well, Don, as we're talking about shortages, especially in silver, a lot of silver comes from Mexico. And I saw this recent story that Claudia Scheinbaum went back to one of her kind of campaign promises of threatening and not granting any new permits for mining in Mexico and or reviewing existing mines. Do you think that is going to cause a meaningful amount of supply to be cut off if that goes through?
Actually, this was in her platform, so she's not saying anything new. Mm-hmm.
But it seemed like once she was elected, she kind of walked it back, and then it seems to be kind of making a resurgence.
Well, actually, she said no new concessions. Mm-hmm. That a concession doesn't mean permits. Unless she's using the word concession to include both leases and permitting. But the way that in the mining, and I don't think she would get this wrong, because I don't think she got her verbiage wrong. In mining, a concession means, okay, so let's say that it's basically land, it's greenfield land, the dirt that's just sitting out there, and you stake it, and then you get a permit to basically to drill, to do exploration on that property. Mm-hmm. And that land is called a concession. And so the concession is the land itself. It's the initial ownership. It's the initial ability to do exploration on it. So we're not going to do any new concessions. So if there's any new ground out there that doesn't have a lease on it, we're not going to give any new leases. That's what a concession means. Mm. So that was actually in her original. We didn't know exactly if she was going to how this was going to unfold, if you will. Now that she got into office, I think this is the first time that she said anything verbally, but she said, yes, we're not going to do any new concessions. So today, for instance, I actually tweeted that out to get everybody's opinion to see if anybody thought she was talking about permits. Mm-hmm. And everybody replied back, no, she's not talking about permits. If she was talking about permits on existing leases, stocks would have crashed today. Mm-hmm. Big time. They would have crashed. So this is really about new land. Now, this will impact certain companies that end up making a discovery on their current land. And because what happens a lot of times is you make a discovery and the land around your property is not leased, right? It's not leased, but nobody's leased it. It's just sitting there, right? Mm-hmm. You make a discovery and you immediately lease the land around your property. Now people won't be able to do that. So there's going to be a few people that get burned by this, because what's going to happen is they're going to make a discovery, and the majority of the discovery is outside of their lease, and they can't lease it. Mm. That'll happen to a few companies, but everybody that currently has a lease is I think going to be fine. Now, we haven't seen. I keep waiting. We haven't seen a new open pit permitted since she got into office. I was hoping that would happen in the first half of this year. It hasn't happened yet, because once they permit a new open pit, then we know they're all going to get permitted. So I've been waiting for that. Mm-hmm. But I don't think that this is the end of the world for like Discovery Silver, Chesapeake. Both of those have big open pits that they're trying to permit. I don't think this is the end of the world for them. Mm-hmm. There's another one, Sonoro, is trying to permit theirs as well. Those are kind of the three stocks that I own that are all open pits that are requiring permits, and none of them have been permitted yet. Chesapeake isn't even trying to get their permits, but Sonora and Discovery currently are. Mm-hmm. So I'm waiting to see that. But as far as, future mining in Mexico, future permits, the one thing that we are going to see, I believe, with Sheinbaum is I do think she's going to drag her feet, because she talked a little bit today. She implied that they're going to have stronger environmental policies. And so that, to me, reading between the lines, means that she might not re-permit existing mines that have any environmental issues, or permitting new mines that have marginal environmental issues. And so water is going to be a big deal. So anybody that's near water, but Mexico is very dry in certain areas, like the northern parts. Mm-hmm. But if you're in an area that like is near a river or something, and then if any local resistance, and you're probably not going to get an environmental permit, that could come into play. Cyanide, some of these open pits use cyanide. That could be a problem area for her. Permitting. She hasn't talked about that. That could be coming down the pipeline. But on the whole, I don't think that this was terrible news today for mining in Mexico. The way that I saw this is, again, this is mainly, and we're going to see it, is that somebody's going to make a discovery, and there's going to be land around that property that they can't lease. And like I said, there's going to be a lot of gold and silver or copper that stays in the ground. But that's only for the next 6 years. So she's in office only for 6 years. Whoever comes after her could change the law. Mm-hmm. So, yeah. And the odds are, if that scenario that I'm explaining happens, the one where you make a discovery and it's on the other side of your lease, you can wait 6 years, right? You just wait 6 years and then, get the concession after, get it later, unless. But it could be a 12-year, and then if whoever if she, I think it's a 1-year term in Mexico, isn't it? Is it one
I'm
and
not
done
sure.
6-year? I think it's one and done. It might be two, but I think it's one and done 6 years. And then so, but it's back. We've had back-to-back liberals in Mexico, so maybe we get another one, and then that would be brutal. You wouldn't be able to lease that property,
Mhm.
but I don't see this as terrible news.
Excellent. Well, Don, that's all I have for today. Is there anything that you'd like to wrap up on that we didn't touch on?
No, I think we covered everything. There's just let's see what happens on July 9th.
Mm-hmm. Absolutely. We'll keep our eyes peeled for that. Of course, for anybody that wants more from Don, excellent Twitter follow at Don Durrett, Durrett, goldstockdata.com, and of course your Substack, dondurrett.substack.com. Don, thanks so much for your time today. Always a pleasure.
Yeah, Tom, thanks for having me on.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.